All right, we're back. So this is part 2 of analyzing multifamily deals, and we're just going to take a deeper dive into all this. Guys, you could literally do a course on analyzing deals. I mean, it could be a 6-month college course. That's how deep we can go with all this stuff. And again, unless that's what you want to do, this is still a great place to start. But again, you're going to be able to learn enough here to talk to the right people, be intelligent enough to get yourself in the right groups, be able to find deals and be able to at least get them, or at least get rid of those 95% that I tell you, so that you're able to move into the other stuff that we want to look at closer and know more about. So what we'll do is we'll start out by actually going in a little bit deeper on the same case study that we have, this Avalon at 3851 North 28th Street. We're going to just go through the operating memorandum, which is what we have up on the screen now. And then we're going to take a look at a few other things as well. We'll definitely go into the T12, which is the 12 months history on the income, so you guys can get a feel for what that looks like. Again, that's a study in itself. That's a really long study. And I feel like my understanding continues to get better each time I go through those, but there's a lot to learn about those in particular. We might even look at the rent rolls, maybe just show you guys how to analyze a few quick points on that. And then we'll go over some deal fundamentals, just some things to check on to make sure that it's a good deal. And then you guys are going to be pretty darn dangerous. Like I said, you'll be good enough to take this to the people you want to team up with and bring in some partners and get some second opinions. So, and we eventually, I might do like a spreadsheet analysis on stuff. Actually, what I'll do is I've done a lot of those, and I'll put those in this module as well, so you'll have access to that. And what that is, I created a software. It's actually right here. I created a software that analyzes deals. Some of you guys know about this, some of you don't, but as you can see, it is pretty elaborate and complex. And I do actually go through this and show people how to use it when they buy this from me. So just give you an idea of a lot of the stuff it's got here. So I will include those videos. I just actually thought about that. I didn't want to go in depth on full analysis because it's so much, guys. And quite frankly, in all honesty, you want to be able to do these spreadsheets and you want to be able to understand how to do these, but at any level, even at my level, which I'm not super advanced in multifamily at all, but even at my level, I created this spreadsheet or had a guy create it for me. You still have to have other people look at it. And I don't think I've ever done one of these perfectly. And I don't think two people even in the industry that are super advanced would ever have the same numbers either. So I'm just trying to explain to you that it gets complicated, and this figures up everything from what your returns are going to be for the general partners, limited partners, mezzanine debt, waterfalls. Like it's super complex, but it's also not. I mean, I'm not trying to scare you away from it. It's awesome stuff, but it's a lifetime work. So jump into it, have fun. But today, let's get back to what we were talking about. We're going to jump into this OM, which is offering memorandum. Let's see if I can drop this down. Yeah, that helps a little bit. Okay, so let's see. So they're going to just kind of give us an overview. And the first things I'm looking at, I'm always looking at locations. Obviously, pictures tell 1,000 words, right? You can even see what the tenants look like in this picture. Awesome. So, but keep in mind, they're always going to be showing you like the very best thing. We went through this a little bit on the last one. I do scan this stuff, so the address, I know this area. I've actually been to this building. Usually live in Phoenix. I'm not there right now. Year built is a huge thing. The older you get, the more maintenance. I mean, it just comes without saying. So, newer stuff is always better, except it always costs more. So you're basically weighing out, and we actually talked about this in some of the earlier videos, you're basically weighing out how much can I afford versus, or how advanced is my team? Because when you get to someone like Grant Cardone's level, they're buying $780 million buildings that are 2 years old, and so if you can do that, those are going to be some nice assets to own. But there's also other strategies where you can buy some older stuff. And we're going to talk more about strategies later on in the course. But 1973 is not horrible. As these properties go through certain ages, there's certain things that you need to be aware of, like the type of plumbing, like the type of, you see, for example, this used to be a boiler system, and now they've switched it out to individual HVACs on the roof, and they've done actually an Insta-Hot. I don't know if you guys have seen those water heaters that are like minis. They're not even really a water heater. They're more like an Insta-Hot wall mount. They're pretty cool. So they've gone through the previous people that bought this before us. This is another thing you want to talk to the broker about, is you want to ask them, okay, so when was it bought and how much was it paid and how much did they pay? You always want to know that because you want to know, you want to know how much they're making on you, right? So, and it's okay. The guys that are selling, they should make money. It's going to sell for market regardless, right? But you want to know when they bought it also, because in the terms of this, they bought it 3 years ago, and they did kind of, I don't know. I don't want to talk badly, but they did kind of what I'll call maybe a lipstick flip. And some of the, actually, I wonder if we can pull that up. Hold up real quick. I'll show you. Okay. I figured I'd just show you some of the pictures, so we could dive into this one a little bit better. So not too bad. You can see it's older. Like you can see on the laminate here where, I don't know what the heck they were doing. They were staggering seams and they just popped that in there. I don't know if they ran out or they forgot to stagger or whatever. Quartz countertops, it's not horrible, but I mean, if you zoom in here and you look at the way they did all this, like not very nice. Like that's not what a remodel should look like, right? And then, let's see, back out. The shower head, they tear the whole wall off, and they should have just raised the plumbing up a little bit. I mean, a guy my size is gonna come into that apartment, and if I don't notice that, I'm gonna be like, dude, I have to duck to get into the shower. I'd have to buy like one of those special nozzles. Anyway, just stuff like that. That goes a long ways. Cinder block, they didn't fur out the walls. I find that kind of annoying. Like if you zoom in on this, it's kind of a crappy deal. Cinder block walls again. Anyways, I wanted to give you guys kind of an overview of that as we were going through it. Let's see here. So yeah, they did come in and do the HVACs. They did come in and change some stuff. And now let's talk about location. So location is literally probably the most important thing in real estate. I mean, it is the most important thing in real estate. You could have the worst house in the world on the perfect lot and it would still be worth millions, right? Because people would want to tear down and build. So in this particular case, anybody that's familiar with Phoenix knows this area. This is what I would call a property that's on the edge of just being good. It's really close to some really nice areas, but it's also on the edge of a bad area. So this is what we would consider a B minus location. And keep in mind, locations are, there's the class of the building, then there's the location. So you've got A plus, A minus, you got B plus, B minus, you got that in both the class of the building and also the location. So this is a B minus, and it might even be a C plus. I think it's a B minus. And we'll show you why. It's pretty close to some pretty cool stuff. This is making me jump around a little bit. So another thing about this deal that I don't like is it's been fully renovated. So basically, let's just read it here. Avalon has been extensively updated, including full modern interior reservations, in-unit washers and dryers, conversion from two-pipe chiller to new individual roof-mounted air conditioning units, updated laundry facilities, and community areas. So normally when you buy a building like this, you want to leave about 40 to 20% of the building, of the units unremodeled. And it's like leaving some meat on the bone. Like these guys have squozed this for as much as they can, and now they're trying to sell it, and they've got their rents, which we'll look at in a minute. They've got their rents moved up to where it makes it very challenging for the next buyer to come in. And so one of my mentors would tell me never renovate all of them. Always leave a little bit for other people, because you guys saw how if you can raise the NOI, it's going to raise up your price. And that's the whole game here. It's called value add, right? So if there's nowhere for us to value add here, not only did they remodel it, they did kind of a crappy job. And so now we're going to come back and try to value add and raise the rents. That's basically what this game is, guys, is raising the rents so you can add value. You have to add value to raise the rents, and then when you raise the rents, it increases the NOI and increases the value of the property. So pretty basic stuff, but they've already kind of squozed this orange, if you will. They've already kind of taken everything out of it. They are close to Biltmore, Camelback Corridor. They're also close to the airport. So like I said, it's in a neighborhood that's not too bad. You can see it's older construction, 70s construction, kind of looks like a hotel. And, tenants notice this stuff. They're like, is that, I've seen worse, but that's part of the reason this property is the price it is. Ultimately, it's going to go for what the market will bear. And I personally think that's around 24 to 25 million. Pool needs redone. See some tiles cracking there. Kind of want to get down to another thing is they've already squozed these guys for, I don't know why they put their security deposit in here, but they've already squozed these guys for everything they can. I'm talking about tenants. Again, it's about value add. So they've got residents billed on RUBS basis each month. So RUBS is a system that allows you to turn, like, instead of having individual meters, because it's an older building, they basically are using RUBS to charge the electricity back, which is another thing we look for as a value add if we're going to buy this. But they've already done that. They're already charging them for gas, so there's no opportunity for us there. They've got RUBS on the water and sewer, so there's no opportunity for us to add there. Again with the trash, so they've squozed this thing, man. Like there's not a lot of value add available here. They're even charging all these additional fees, like if you want to have a parcel locker, or you want to have pest control, might not even be optional. They've got a solar fee. Crazy, right? And again, we went over this on the earlier video. Okay, so now let's look at the unit mix. So we have 81, which is 69% of them are 1-1s. And then we've got the remainder that are either 2 1.5s or 2 2s. Now this building has a little bit larger size units than most, just slightly larger. But there's a couple schools of thought on this, and it does change quite a bit. 1-1s are generally going to be harder to manage. They're generally going to be, rather than a couple who tends to be more responsible, they're going to be kind of maybe your single guys or your single girls that are possibly at a different stage in their life. So just in general, 1-1s and studios are going to be more of a headache. They're going to be a higher turnover, depending on the neighborhood. But that's not a horrible unit mix. But we'd rather see 2 2s and 2 1s, or 2 1.5s or 2 2s are ideal. 2 2s are ideal because you've got, once you get up to 3 2s, some people don't need that much room. 2 2s are great for couples, and that's really what you want, is you want couples in there. Let's see, anything else we want to bring up here? The square footage is a little bit large. We'll go into that in just a second. You can see all the solar panels they got on the top of here. So we got back to the broker to find out. I can tell that these are older panels because the new panels are solid black. These are a little bit older. I'm guessing, and I bet you I'm pretty close, I'm guessing these panels only produce about 50% of the power that's used. And then they're turning around and charging them for the power, and then they're also charging them a solar fee. So, like I say, they've squeezed all the opportunity out of this. And they may have a lease on this solar system that they're not listing. I didn't see it, so I'm guessing that they do not. But they've gone in and they've redone all of the, most people be like, oh, this is nice, you want to buy this. Well, no, actually, we want the old stuff in the nice neighborhood so that we can fix it up and raise the rents by 300 or 400. That way we can actually make a ton of money. If we were to raise the rents by $300 on this, let me just do this math real quick for you guys. There's the biggest thing here is there's not a lot of value add, but if there was, let me give you an example. So let's say we could raise the rents $300 times 117 units times annualize it 12 months. That's an additional, we already saw this number once. That's an additional 421,000. I already know what it's going to say. So divided by a 5 cap, let's call it. You just added $8 million in value to the property. But the problem is there isn't any value add. So that's how you make money, is you do the value add. You know, they've already put washers in here. I don't know if they're charging for covered parking, but they probably are. Pretty cool layout. Nice size building. Show us the floor plans, whatever. Now, this is a good location. We'll go into this a little more. You've got a high-end grocery store right here. You've got the Starbucks right next door. That's always a good sign. These type of companies do not put money where there's not money to be made, right? So that's a good sign. Yeah, Biltmore's up here. Biltmore's a really expensive area. That's a good 10 minutes away, but it's not horrible. You can see that they're not in the nicest hood, but it's not horrible. A couple more looks at it. So yeah, there is up at Biltmore. I mean, that's one of the nicest places in the state of Arizona. So we're going to go into demographics for a minute. You know, you can look at average household income. You want to make sure that the people in the area can afford it, right? You run into this in, like, we were looking at a deal in Arkansas and we didn't end up buying it. Actually, Grant Cardone was my partner and we didn't end up buying it. I ended up backing out of it, and he told me that I did a good job because when we looked at the average household income, it was like $33,000. I mean, it was so low. These people couldn't even afford a rent raise, and their rents were only $600. So another thing you want to do is you want to compare the median home value to your average, or to your cost per unit. So if you look at our cost per unit at 29 million, which is high, divided by 117 units, so we're about 250,000 per unit. So that's well below the median home value, which it should be, but that's, you know, this is actually pretty good per unit price, but there's a reason, right? It's because they did a crappy job on the remodel, all the things we've already talked about. So there's so many variables, like there's so many trade-offs, and anything at the right price is buyable. Like if it's the right price, you can lower the price enough to make anything attractive. Large population, that's a big deal. I see a lot of deals come to me that people want to invest in towns of like 30,000 or 30,000 is actually maybe doable, but in a town of like 8,000, 10,000, then, you know, it's just hard to get when you have a vacancy, it's hard to refill it. So population's huge, guys. Stay out of tiny towns, even if it's your old hometown, especially then, stay out of it. They're talking about some of the industries in the area, which is very strong in that area. So here's Biltmore, but they're like 10 miles down this road. Not 10 miles, 10 minutes, but. So CapEx, capital expenditures. They've done some exterior CapEx. They've done a ton of interior. We looked at that. They could have just gone a little bit further and done a lot nicer job. Would have made a big difference. Okay, so now we're going to get to rent comparables. This was a really big problem for me. So the Avalon right now, let's see here, on 1 bedrooms, the Avalon, which is the subject property, is at $1,450. The average in the comparables is $1,250. So right there, they're $200 above the market average. Now, and then on a 2-bedroom, they are $100 above approximately. So what's that tell me? That tells me I can't raise the rents. Now, why they're showing me this is they're saying, oh, look at the price per square foot, Brad. Since our units are bigger, our price per square foot's low. So look, you have room. You can bring up your price per square foot. You can bring it up to here. But that's just not always true. I mean, if you're thinking about yourself going to an apartment building and you're, maybe with your girlfriend or your wife, and you're, if one of them is $200 more and has a shitty remodel, to be honest, then, you're not going to say, oh, hey, honey, this is 100 square foot bigger. You may notice the kitchen's a little bit smaller, but you're not going to change your place based on price per square foot. I mean, in the industry, we use price per square foot a lot because it just kind of tells us, it's another metric that we can use. It tells us a lot. But in this case, I'm super concerned about these rents being higher than the market rent. What that tells me again is, where's the value add? Like I said, they've added value. They've already squeezed this orange to the point of it is like dried out, sitting on the sidewalk in Phoenix. Like there's nothing left here. So they're going to go into some comparables, and they show you the map of where they are, very similar to residential. The problem is these comparables have some pretty good prices, but everything was selling for more in the past year than it's selling for now because interest rates have gone up so much. So, I mean, there is a lot of data to be taken here. There's another large map of it. They're showing you the average square feet. Downtown Phoenix. Major growth here. Well, kind of reversing right now, actually. Okay, so what you want to do too, going back to, everything is about how much money you can bring in. It's all about the gross revenue, which creates the NOI, which creates the value, because we learned that in the previous lesson. So what you want to do is, you don't even want to take their word for any of this. You want to go out and see what the market can do. So you actually want to call each and every one of these places and find out how many places they got open and how much they're charging. And then you want to go actually walk each one of these places. I'm talking about, this is phase 2. Like you actually want to go and look, obviously, at the subject property. I don't know if I mentioned that yet. You're going to go tour that probably twice at least. And then you're going to go to the Solaris, the Echelon, the S29, and you're going to compare them, and you're going to take notes, and you're going to create a spreadsheet, and you're going to say, okay, the Solaris has a 2-2 at this price, but it has a nicer pool. It has a better location. The Echelon has a 2-2 at this price, definitely has a nicer pool, but its location is a little bit worse. So you're going to weigh all these, and just like the same way we decide what we want to pay for this building, we can decide, how it compares, like think of it as if you're going to go rent one of the units, and you're going to take enough time, because this time you're not just in for $1,500 a month, you're in for 15, 20, 25 million. So you're going to actually go look at each comparable. You're going to walk the actual insides of the comparables. You're going to check out the pool. You're going to check out the location. And then you're going to know what you can charge and why. You're going to know what each one of their vacancies are. And you're going to know what monthly amount you can get. And what you're probably going to find out in this case is that they've already raised the rent right here as much as you possibly can. So, let's see. Yeah, so that's a huge red flag. Okay, guys, let's go ahead and look at, I think we've kind of killed that. Let's go ahead and look at, see which one we got here. This is going to be kind of hard because of the way my screen is set up. Let's see. I'm going to make this, that should work for you guys to view that. So this is what we call a T12, and what it means is it's a trailing 12. It means the last 12 months of their accounting. So if you scroll over to the right, you can see it's 12 months, and then it has the annualized over here. So we're going to the problem with this is and these are hard to look at even on a big computer, but I'm not sure how this will look on your screen. Should look pretty good. So it starts out with your income, and then they do what's called a loss to lease. So what this is they're saying, well, if we were in our best case scenario, the market rent times the number of units would be this. But then they're saying our loss to lease means that we have X amount of units that are not that are leased in a lease, but they are not at the market rent. So that's what loss to lease means. That's how far they are under what they could be. So this is the truth right here, what they're actually at. And then you've got, we can go through most of this. I'm not going to go through the whole thing. So you got vacancy loss. So this is what their percentage of vacancy is. So right now we're saying, well, this is kind of what we talked about on lesson 1. We said that, 117 units at this amount gives us this. Well, guess what? 10% of them are vacant. And look at these vacancies over time. They tell a story like, why did this go up? Oh, we were remodeling. Okay, but I want to know, why did it go up? So 171,000 lost in vacancies. Rent concessions, that's like, those are like promotions. Bad debt is stuff they've had to collect on. What the hell? I didn't see that. $48,000 in bad debt in the month of July. Definitely something I would ask the broker. They probably let a lot of people go late, and then they had to go after them. Who knows? There's that thing again. I gotta look that up because I don't know what that means, and I should. Actually, you know what? Let's do it right now. Hold on one sec. Okay, learn something new every day. So CAM allocations are what's called a common area maintenance. So remember we saw this. Let's go back to where we're at. Hold on. We saw this in other income. So they've done everything they can. They're charging. In some ways, that's smart. I mean, it is smart as an operator. But now that they go to sell it, like there is not a single extra thing we could possibly charge. We can't charge more for rent. We can't charge more for CAM allocations. We can't charge more for pets. They're at $350 per pet. Like, where are we going to make any money? They even got solar charges, like crazy. Look at this. This is their other income right here. So pet fees, cleaning fees, admin fees, deposits, amenities, late fees, month NSF fees, termination fees. I mean, these guys have really squeezed this orange, which is, more power to them, but they should be trying to hold. And the reason, this brings me to a point we should have brought up earlier. The reason these guys are selling, we always want to ask, what's the price? Why are they selling? And are they really sellers? And what I mean by that, are they just kind of putting it out there to see how much money they can get? Or are they actually a seller that has to sell? In this case, these people have to sell because their adjustable rate mortgage had 3 years on it and it's coming up. It was in 2020. And now their adjustable rate mortgage comes up, and guess what? Their expenses, their mortgage payment on this building is going to be, I could only guess, probably $500,000 more a year, something crazy. So they're in a position to where they can't afford to keep this place. They kind of got themselves in a bad position. They should have left. I don't know. Maybe they should have bought it cheaper. That's hard to say. So now they're just going to get into all the expenses, guys. So you got payroll, administration. Now, if you get a little more advanced, and this is kind of the area where I'm at, where I'm still learning this stuff, but you're going to look at things like, this is their maintenance supervisors. This is basically one person's salary. If you go over here to the right, he's making $54,000 a year. That's about right for a maintenance supervisor at an apartment building. One full-time dude. Let's see. Now here's the manager's salary. Same thing here. She's making $52,000 a year. Oh snap! I'd be pissed. I would just be like, I want to make more than that guy. So that's what I told you guys about, and those are pretty much right on, because when you get above about 60 units, you can afford to have a full-time person. So some of this stuff's pretty close here. Management. What is this? And most of these T12s are a lot of the things are the same and a lot of things are different. So what I mean by that is there's kind of an industry standard, but then there's also people are putting different expenses in different places. So it's an ongoing battle to learn these things. And what you have to do is you have to look for areas in here that something's wrong. Like for example, I know what this is, but this is property taxes. And this is a credit from the previous year when they bought it. So because sometimes you can get a credit, but you can see they're paying $5,000 a month of property taxes. They're paying $3,700 a month in insurance. Looks like they got a better insurance company right here. Saved them a bunch of money. After, these guys are pretty good operators, looks to me like. Now we've got our debt service. It's $62,000 a month, and it is 1 million. Yep, I bet you it's 1.1 million a year for their mortgage, and I bet you it's going to go up by probably 500,000 because it's going to go from probably like a 2.9 to like a 5.9 rate. We can figure it out real quick if you want. So these are going to be some assumptions. They bought this for I think 23 million, and they probably have 80% loan to value, so that would be 17 million dollar mortgage. And if we times that by their rate going up 3%, say times 12, that's the increase in their mortgage. I mean, that's obviously there's some assumptions there and there's other variables, but as you can see, they can't afford that, and we're going to see why here in just a second. Well, I'm not sure anyone would want to afford that, but now they're going into their CapEx and all the money that they put in. One of the things that's interesting about this is a little bit higher level thought pattern, but when you're going through and you're remodeling each unit, which is basically what these guys are doing, when the unit turns, meaning the person moves out and they're remodeling it, they don't accrue any turnover cost because all their cost they instead they put it in their CapEx. So what's happening with this? Remember, I told you that their expenses are only 25%, which is incredibly low. One of the reasons is they're not counting any turnover fees because it's just being absorbed by the capital expenditures. Because instead of having a normal turnover fee, when I say fee, cost is probably the right word, a normal turnover cost of $1,500 per unit or whatever, they're just saying, well, we'll just remodel the whole thing and we won't have to count that as an expense because it goes in capital expenditure. So a little higher level thing, but that's one of the reasons why these guys got their expenses so low. But the bottom line is no one wants to buy this thing, and they are losing their ass right now. And I'm going to show you how and why. Okay, so at the end we get total net income, and then we get NOI after adjustments. So this is how much they lost last year, $362,000. Now some of that's coming out of CapEx, and that's to be expected. But something else that concerned me, and it gets really hard because you can't read. But you're gonna have to take my word for it. Their total income minus their total expenses, except for their mortgage, created a 25% debt ratio, or not debt ratio, expense ratio. So I was like, bullshit, like that is not even possible. So anyways, guys, that is some of the stuff we want to look at. So let's see here, go back to the beautiful Avalon. You can see how if you weren't advanced, you might think this is a good deal. Like you might be like, oh my gosh, this is a really good deal. So let's see, let me look at my notes here, see if I forgot anything else before we jump off. One of the things that one of my mentors told me is never guess no. Like you can't afford to make a mistake in this industry. I mean, the good news is usually your team's not going to allow it, and then the bank's usually not going to allow it because the bank is, you kind of got to look at the bank as a partner because the bank is not going to give you any money unless it pencils out. So they're going to underwrite it. They're going to have a team of analysts that actually underwrite the deal. So they're your partners. You're not your partners with the bank. You're not enemies with the bank, but you should know, and you should you should know right when you get there if you feel it. The problem with that is when you're brand new, you're gonna feel everything. You're like, oh my God, I want this, I want that. Let's see here. You also have to always confront the worst case scenario. Like right now, we're going into a market where the vacancies have gone up more than they've ever gone up, I believe, and at least in a long time in Phoenix. So we're seeing increased vacancies. We're seeing increased inventory come on the market. We're seeing a housing crash combined with a drop in rental rates and a surge in vacancies. It's like a triple barrel crash. So when you buy right now, you have to be even more conservative, because when they were buying 2 years ago, they could be like, oh, dude, we'll just raise the rents $200. Like the rents went up in the last 3 years. The rents went up, $400 or $500, $600, $1,200 in Miami. So now that's all going to start coming back down. So it's actually going to go the opposite way. So you have to be prepared for that. You have to build that into your numbers. And I guess we'll close with this. When you're new, you always want to figure out a way to make the deal work, because who doesn't want to own this building? I mean, if it's, let's assume it makes money, which it doesn't. But if you don't realize it doesn't make money, who wouldn't want to own this? I mean, how cool would that be to own this? Yeah, I own 117 units in Phoenix. Pretty cool. So you get like this emotional tie to getting it done. And all you start to wear blinders, and all you see is the good things in the building. And so you really have to have second set of eyes. You have to look at this with no emotion at all. It's all just logical. It's all just like analytical. It's all just numbers. It's really all numbers. And then you have to be completely open to all the things that could go wrong. It's amazing how when people bring me deals and I show them what's wrong with it, I've seen this has happened multiple times. They'll still pursue the deal and they can't get it done. The bank won't approve it or whatever happens. Or I saw one person lose $500,000 in earnest money when I told her that she was estimating her rents too high, but she wanted that deal, man. And it was a cool deal. I get it. It was down in South Florida, it was in a cool place, and it was brand new construction. This one was, and she wanted it, and she put so much of her heart into it that she couldn't back out of it. And I'm like, dude, you're estimating your rent's too high. And so she ended up losing a bunch of money. Some of it wasn't hers. So long story short, guys, take your time with this, go through these deals in depth. Check out so we've got below this, you'll have some case studies that'll be similar to what we just did for a couple other properties. And then you'll also have some videos, at least one video that shows you how to run the deal analyzer. And what that is again, that's the in-depth. We looked at it just a second ago. That's all this in-depth stuff where you're going to start learning all this kind of stuff. How to type in your rents and how, it gets cool. Like if you're and another thing with this is, I mentioned this in my book, how to buy 5 ways to buy apartments with zero down. You can get on Amazon. But another thing about this is some of us are analytical, and if you're like me, you're like, spreadsheet. Like, I want to learn, what does this mean? What is that? What is this? Other people are like, spreadsheet, get that thing out of here. And usually the people that don't like the spreadsheet might like to be on the phone more and talk to people more. So just figure out what you're good at and focus in on that. If a spreadsheet freaks you out, then maybe don't do the spreadsheet part of it. But if you are like me and you're like, I want to know more, I want to understand more, I want to get better, then I went out and created this spreadsheet with some help, obviously, and I'm still learning how to properly use it. I mean, it's pretty complicated, guys. It just you can always get better. That's what's really cool about this. You can make a lot of money. You can always get better. But hopefully today we told you a few things that will help you not lose your money, not lose your family's money, not lose your investors' money. And don't be afraid to turn a deal down. Sometimes that's the best decision you can make. All right, we'll see you on the next one. I'm out.